Hi everyone, and welcome to our market volatility update. We might just pause for a few moments to let any late people to our webinar, and then we'll get underway very soon. Okay, well, we might get underway. Thanks again for joining us at short notice. It's obviously a very significant time in investment markets. My name is Clint Abraham. I'm portfolio specialist for the Morningstar Investment Management business, and I'm joined by Jody Fitzgerald, who leads our institutional capability here in Australia. And what we wanted to do was share an insight into what we think is happening in the world, give you a bit of an update on where we see opportunities, and most importantly, allow an opportunity for you guys to ask questions. We imagine your clients are feeling the pressure a little bit, and we wanted to give you as much opportunity as we can to ask the key questions that are important to you and to them. Before I do that, may I remind you that this session has been prepared, excuse me, a slide there. May I remind you that this session has been prepared as general information only, and as we haven't considered anyone's individual circumstances or objectives. So with that, I might hand over to Jody.
Thank you and good afternoon. Thank you for joining us and taking time out of your day. We might skip straight to the next slide if that's okay, Clint, because I know that there's potentially going to be a lot of questions at the end of the presentation, so I'd like to move through it pretty quickly so we can get to your questions. Basically, at the moment, we're in the midst of an exogenous shock in the market. And in fact, you could say almost that there are two shocks. The first is obviously the global pandemic, and the impact that it will ultimately have on the economy is still largely unknown. We don't know the degree to which global economies will go into a recession. If they do, how deep and how long and protracted it will actually be. The other shock has actually been the behaviour, I guess, between the Saudi Arabians and Russia with regards to a dispute over oil production, and the Saudis trying to effectively jawbone Russia into behaving themselves. So from the market's perspective, there's obviously a demand shock associated with an economic slowdown, but at the same time, we're seeing a supply shock. So what we're having at the moment is markets, which, you know, it doesn't take me to sort of point out that they're quite panic-driven at this point in time. And that panic is really being driven by unknown unknowns around the coronavirus. Basically, there's a huge amount of uncertainty in the markets, and markets and businesses do not like uncertainty. So we're in the midst of a generalized sell-off. And what we find at the first stages of these major market corrections is that they tend to run in stages. Stage one, which is what we're in at the moment, is actually the hardest stage to manage through as a portfolio manager, but also when it comes to getting your clients to understand what's happening and to be calm. So this phase of is basically the indiscriminate selling and whipsawing volatility. So basically, what we're finding is investors are looking to sell anything at any price, basically. Get out, put the cash under the mattress. We're seeing that whipsawing come through where one day the market will be down by 7, it'll be up by 5 the next day, and then down by 7 the next. The price movements are not explainable or understandable. So this is phase one. The second phase that we'll go into, and there's no understanding really of the timing of what will actually occur, is when that volatility starts to actually settle down in the market. So that's not to say that we still won't, that markets will actually start to recover, but price movements will start to become understandable. If a company is actually experience a downgrade of its share, that will actually be linked to fundamentals, an understanding of how has the earnings been impacted by these situations, its free cash flow, etc. So this phase at the moment that we're in is actually not smooth, and it's quite a turbulent phase in the market. But amidst all of this sort of panic selling, we've seen some fairly phenomenal responses from governments and also companies with regards to how they're going to handle this, what is effectively an unprecedented event. So not only are we seeing a huge impact from monetary policy, which is going into territory that we haven't seen before. So zero rates in the US. The RBA is meeting soon and expected to announce cuts in rates and QE type program into the market. At the same time, we're actually going to see some firsts, I think, happening in the world. One of those is probably going to be the Treasuries starting to take over with regards to getting stimulus into the economy. So this is you've probably heard people talk about modern monetary theory. Over time, that's effectively what this is. It's the idea that a sovereign government cannot go broke as long as it can print its own currency, effectively. So it can have as much debt as it wants. It can just print the currency to pay for that debt. That's the theory behind the modern monetary theory. Now, where that becomes problematic is where there is no capacity left in the system, and that printed money causes inflation. Clearly, I think we're probably all of an understanding that coming through this crisis, there will be an economic impact and that there will be capacity. So fiscal responses do work, and even though there's a lot of governments globally with a lot of debt, sovereign governments are able to manage that through their currency process. So there's a wide range of expectations out there at the moment with regards to where we go from here. There is no consensus at the moment at all. I've seen estimates for next quarter GDP to be -5%, and varying ranges around that. And there are others who are predicting that you'll get negative GDP for 2 quarters and then it'll bounce back and we'll be back into sort of the normal state of play. But the thing is, we just don't know at this point in time, and the markets are responding accordingly. So if we move to the next slide, as I mentioned, we're seeing absolute indiscriminate sell-off, and equity markets have fallen below that -20% trigger, which is where we move out of bull market and into bear market territory. So the 11-year bull market that we've been experiencing is definitely officially over. What we've found, though, is that during this time period, your equities have underperformed quite considerably, but the bond markets have held up okay. What we're finding is somewhere between -1%, -2%, depending on the market you're actually talking about. We're starting to see, I'm sure there'll be some questions about this later, some liquidity issues in that market, and any market which is an over-the-counter type market, they're starting to become issues. But if we move to the next slide, you'll note that basically, all markets are being impacted quite heavily by this. So as at last night, the US market was down 28.9%. Australia's down almost 30%. The UK, 31.7%, Japan, 24%, and Europe's actually been hit quite hard. It's down 37.6%. For us as value investors, amongst this uncertainty, what we're doing for you is actually searching for the opportunity. So this is definitely a health crisis, but it is soon becoming an economic crisis as well, and it will have real impacts. As long-term investors, though, we're looking through that short-term noise that's occurring in the market and determining where and how we can actually pick up cheap assets. So can we buy $1 worth of assets for 50 cents? The short-term volatility, as I said, we do not know when it will actually end, but what we do know is that fiscal policy is an effective tool, and that the cycle will continue. Companies and country and economies will recover from this. The time is unknown, but they will. Assets can we pick up that are good quality assets where there is a margin of safety that will actually, we can pick up at a cheap price for our investors. You've probably, if we move to the next slide, you would have heard us say a lot actually that, the time to prepare for these sorts of events is not now, it was months ago. And we did that in our portfolios. We have been doing that in our portfolios. And just to give you an example, if you have a look at what occurred after the GFC, the light blue line represents somebody who stayed fully invested during the period. It's not easy when the market is gyrating so heavily, but that portfolio has substantially better outcomes than the dark blue line, which is somebody who exited the market, sat on cash for a year in the hope of actually timing and getting back in. Because what we find is when the market actually reverts, it reverts quickly and hard. It's important that you have enough risk in the portfolio, that you're taking enough equity exposure, but that you're taking it in the right areas to actually do that. So I guess, this event, it's an X factor event. There's absolutely no way we could have predicted what would make markets turn, or the timing of it, or the severity of it, essentially. But leading into this, we were concerned about market valuations and that market valuations were not reflecting fundamentals. So as a result, we were actually underweight the most overvalued markets. So within our real return growth fund, as an example, growth capability, whether it's the fund or the SMA, we were holding significant levels of cash, predominantly underweight the US, well, mainly very little holding in the US. There was only a sort of a handful of holdings there in healthcare and consumer staples. And underweight Australia. That's put us in a stead that as we go into this crisis, one of the things that you've probably heard us talk about before is because of the power of negative compounding, it's really important to avoid downside losses. The reason for that is the less you lose in a down market, you then start compounding from a higher base once the market turns. And that is actually a significant generator of wealth for clients. So how have we done? Well, since the market started to sell off on the 21st of February, the real return growth strategy or the growth fund has only captured 68% of down markets. So on days when the market is negative, we're only capturing 68% of that. So that's the capture ratio that's great. We're very happy with that. On the flip side though, there's been 5 positive days. There haven't been many positive days and they're varied in terms of quantum. Some of them are extreme, like plus 10%, plus 7%, etc., depending on the market. We've only captured 42% of those up days. Now, that's not surprising in this phase of the market where we've got indiscriminate selling, but then also indiscriminate buying. There's a great story out of China. There's a, as you can see, we're all working remotely now, and we use Zoom. The Chinese company called Dollar Zoom actually had its share price through the roof because people incorrectly assumed it was the teleconferencing company that now people will be leveraging from work from home. So as I said, there's just indiscriminate buying, panicking, etc. So on those up days, when we've got whipsawing volatility, we certainly don't expect to actually capture it. When we start to move into the second phase, where the volatility lessens in the market and price movements become rational and understandable, you can link a price movement to an actual reason, we will expect to start capturing more of the upside. So today, and I wanted to share this with you, so our global CIO actually sent a message to all of us today with one of his favourite Warren Buffett quotes. He loves to quote Warren, so I thought I'd read this to you because it perfectly sums up where we're at. Every decade or so, dark clouds will fill the economic skies and they will briefly rain gold. When downpours of that sort occur, it's imperative that we rush outdoors carrying wash tubs, not teaspoons. And that is what we will do. So leading into this, as I said before, we were underweight the most overvalued parts of the market. We were holding, circa 25% cash, etc., and very high quality fixed income holdings. So we actually have the ability to run outdoors with those wash buckets and capture that gold. So what we're doing at the moment is we're looking to redeploy and pick up assets. Some assets at the moment in the market are selling at 2004 prices. The market is pricing in some instances, Armageddon, which we know is never usually the case. So as a long-term contrarian valuation-driven investor like ourselves, we're looking through the fear and the noise, and we're trying to position the portfolio to take advantage of these cheap assets and the fact that the cycle will always exist. The cycle will always continue. This won't last forever, so we're looking through that. And I'll hand over to Clint now to walk you through the opportunities that we're finding.
Thank you, Jody. Talking of Warren Buffett reminded me of one of his very famous quotes, which I paraphrase as being, you should be greedy when others are fearful and fearful when they're greedy. And certainly that fearful element of investors at the moment is something that we're very observant to. We think in select markets in particular, you're seeing very, very irrational behaviour, which is consistent with that panic theme that Jody touched on a little bit earlier. So I wanted to give you a little bit of insight into where we are seeing opportunities at the moment. That irrational behaviour we think is most prominent in the energy sector. And again, there's a couple of different things going on with energy in terms of coronavirus impacting expectations of global growth and therefore demand, as well as the OPEC type situation, which is raising concerns around oversupply at this critical time. What you can see on this chart is the broader global share market in green, global equity market in green, and the energy sector in particular in blue. And you can see it's a significant dislocation, down around 50%. Global oil has fallen significantly over the course of 2020, and that's flowed through into very poor sentiment toward the energy companies. But when we actually have a look at the companies that make up that sector, we think they are very, very high quality businesses. We're talking about the likes of BP, Shell, Total, Exxon, Chevron, etc. And we think that they have the levers to pull that can help them navigate this challenging oil price environment. Interestingly, an oil price down around this level is not unprecedented, nor is escalating tensions amongst OPEC members or indeed broader significant oil producing countries. So what we think is happening is that poor sentiment around the outlook for the oil price is obviously flowing through into the individual companies, but they remain very well positioned to navigate this environment, and that's what makes us think that this is not a value trap. In actual fact, what we see in an otherwise generally expensive world, albeit less so given the falls that we've seen, the energy sector stands out as one particular asset that we think is cheap. Investors are being very well rewarded for the risk of investing, and it's a key area that our portfolios have looked to invest in over the last little while. To give you an idea of what our portfolio weighting is for both our growth real return fund and our managed account, we have a look-through position in the energy sector of around 10%. So this is us doing what we're doing as valuation-driven investors, very much contrarian investors, identifying that irrational behaviour in the market and sizing the position in a way that's consistent with how attractive that opportunity is. And I'll put some numbers around that in a moment in the context of some of the other assets that we look at. So for those that haven't seen this chart before, what we're looking at here are expected returns after inflation for the key global share regions. And this is annualized data on a 10-year view. And as you can see across the bottom, it's demonstrating those expected returns at various points in time. And on the right-hand side of the chart, you can see how those expected returns have ticked up quite significantly. So what we're saying there is that share markets around the world have fallen, as Jody mentioned, quite indiscriminately. We can recognise now that there is much better value to be had following those gains. Now, interestingly, while all of those key regions are showing better expected returns, the relative appeal of one region over another hasn't really changed in terms of our views prior to this most recent sell-off. So our preference remains UK share market, Japan, and then you can see emerging markets and Europe there. And then at the bottom end of that chart, Australia and the US, which we felt were among the most expensive share markets coming into this sell-off. When we have a look at global share market sectors, again, you can see on the right-hand side how all of those sectors are, generally speaking, more attractive. But just look at how significant the moves higher in energy and financials are. And this is very much consistent with this theme in the market that any of those sectors that are what we refer to as cyclical, they are sensitive to changes in expectations around the outlook for the economy. Those assets have been very harshly dealt with. This is what's giving us a significantly greater expected return, a much stronger margin of safety, and it gives us the confidence that we should be owning more of these assets, and the portfolios are positioned to reflect that more positive view. What you'll also see there is some of the more defensive sectors, those that there's a perception that their earnings are more resilient to changes in the economy. They've actually held up pretty well. Again, this is very consistent with how investors behave in times of uncertainty. They want to invest in those sectors where it feels safest to do so. Again, as contrarian investors, we're looking for those opportunities where investors have made irrational decisions and effectively broken the link between understanding the price of an asset and what its actual value is in the long run. Again, that significant uptick in energy is the key reason behind our much higher weighting to the energy market. And while this is a world energy chart, a world sector chart, if I was to break this down into, say, the US or the European energy returns are even greater again. So we think there's a significant opportunity in the energy market, in the energy sector, which we want to invest on behalf of our portfolios. If I have a look at bonds, what you can also see there is that, yes, generally slightly better valuations more recently, a bit more pronounced in the high yield market. Again, that has a lot to do with the changes in expectations around global growth and particularly with regard to the oil sector. Better valuations, but again, what we're seeing is the risk of losing money generally in bonds is still quite elevated. And this is a concern for us because bonds are the defensive component of your portfolio, but we think that the ability of bonds to diversify share market exposure is becoming much more limited when the starting point for both is actually quite expensive. So in recent times, you've actually seen both shares and bonds selling off at the same time, very much as investors move to those assets that they can actually get some liquidity out of. I wanted to share with you a bit more detail around how the portfolios are investing, but before I do that, I wanted to just work through what a series of losses actually looks like, or a drawdown, what it looks like practically within the portfolios. And so in this example, we've got a 60-40 portfolio here, 60% growth, 40% defensive. And I wanted to make an assumption that the growth component of that portfolio falls by 20%. So it falls from 60 back to 48. If you had a $100,000 investment across that entire portfolio, it falls back to 88,000. Now, by extension, if we assume that the defensive part of this portfolio, it doesn't change, so the returns are flat from this period, the overall size of the portfolio will fall to 88,000, as I said, but the resulting asset allocation will be actually quite different. And what you'll see there is that the defensive assets, and cash in particular, the allocation can float higher purely because of the growth asset falls. So we're not necessarily making an active decision around cash as such. It's just floating higher because the equity component has fallen. And so the reason I mention this, we'll share some information around where the portfolios are currently positioned. But as you can see in this example, for me to get back to my pre-drawdown levels, I effectively need to rotate 12% of that allocation out of the defensive and into the growth component. The reason I mention that is because for our growth managed account and real return fund, as Jody pointed out, we approach this situation with quite a defensive positioning. If I look at our early March positioning, which was really just as the real volatility hit the market, perhaps 1 week into the sell down that began around the 21st of February, our positioning for a growth portfolio was about 55% to growth assets. Now, in the ensuing 2 weeks, we have been aggressively taking advantage of the opportunities where we think we've got the valuations that are going to deliver long-term returns to clients. So much so that not only have we reweighted back to that starting position, we've actually increased our growth exposure materially. And so as it stands at the moment, both the growth real return fund and the growth managed account, they are currently at around 66% growth assets. So they've moved from 55 to 66 in roughly 2 weeks. This is us aggressively buying up on those opportunities that we think have been irrationally priced in the market. When we look at where we've been adding those growth assets, there's an element of broad market exposure. So as you've seen on a couple of charts beforehand, that broader markets are now significantly weaker. We can add back a little bit of that market exposure in recognition that we're just getting a much better valuation there now. But more specifically, it's been into individual sectors and companies. Now, I touched on energy, which is applicable for both the real return fund and the managed account. But for your interest, for those looking at the managed accounts, we've been increasing our Aussie equity weighting through a number of individual holdings. And specifically, we've bought allocations in Medibank, Insurance Australia Group, BHP, Amcor, AGL Energy, as well as increasing our weighting to Woodside and Brambles. And so our Australian equity account now is up a little bit north of 13%. That's up from about just under 10% leading into this period of volatility. As I mentioned, our energy exposure is also around about 10% for both of those portfolios. So just in the interest of time, I might pause there and open it up to any questions that you might have.
One of the first questions that's come through is that there's a lot of discussion about continued interest rate cuts. What is the rationale for this? Is it purely to ease consumer debt, or are there more broader perceived benefits? Look, definitely it's to put confidence back in the system and consumer debt and so forth. But one of the main reasons why central banks will actually do it is to provide a liquidity mechanism into the markets as well. So the Fed, for example, taking interest rates down to 0 to 0.25 because they have a range over there as opposed to a hard number. Prior to them doing that, the yield curve was basically flat. So the yield curve, even out to 30 years, was under 1%, which was phenomenal. Never seen it before. By pulling down the front end of the curve, you actually start to get force shape into the yield curve. Now, shape in the yield curve is really important for credit markets to function, for banks to make profits, and a healthy banking system is extremely important for any healthy operating economy. So there's more than one facet behind why central banks use interest rates. Obviously, of ammunition though at this point in time. So outside of quantitative easing, hence why I mentioned we'll probably start to see treasuries departments taking over in terms of actually, because the way printing money works is the treasury basically just puts a line through the debt that's actually owed. It's equivalent to printing money. A side question of why is petrol in Melbourne $1.56 when oil's at record low prices? That might be a question for the ACCC rather than for us. But, you know, there's always going to be delays anyway because petrol the oil needs to be refined and turned into products. But yeah, I suggest you ask your local petrol Bowser about that one. Okay, sorry, I'm just scrolling down some of these questions. Will a vaccine be able to stop the fall and start a recovery? No, is the answer. This is one of those unknown unknowns. Whether it's a vaccine that actually is created, or you've heard the phrase flattening the curve, which is actually reducing the number of transmissions and sort of getting on top of it, that alone might be enough to actually start the recovery, whether it's a vaccine or not. It's difficult to actually difficult to tell what that point will actually be, which is why we say to clients it's really important that, you know, if you look through the noise and look through the fact that markets are down broad-based 30%, in some sectors they're down 50, 60%. If you thought those assets were decent assets at the beginning of this year and you feel that those assets still have a margin of safety in them, it makes sense to start buying them up at those cheaper prices. Okay, Jody spoke about stage 1 being a reduction with fundamental. Do you have an opinion on whether the overall market will find support? For example, at the ASX 4,000, 3,000, lower than the GFC. Again, difficult to tell. I think that I suspect this volatility will start to calm down once we start to get an understanding of periods of lockdown, how long they'll last for, and the flattening of the curve that everybody keeps actually talking about. Where it finds support is basically where it won't continue to sort of nosedive like this. The fiscal support that's starting to come through, as I said, we're seeing unprecedented levels of fiscal support. And as I mentioned before, with the concept of modern monetary theory, a lot of governments actually do have enough firepower to be able to actually manage this. So, so that I would hesitate to guess where it would actually fall to, because we know we will never time the market correctly. But getting in is kind of important at this stage. What energy stocks are you investing in? So with regards to the funds, and I'll let Clint talk a little bit more about the SMAs with this regard. The funds, we're taking up broad-based positions across Europe and US in particular. So basically we're talking about the big integrated guys. So we're not investing in the shale guys, the little guys that are going to have sort of those high yield credit debt issues and may not be able to roll over. And there are also producers that are very, very sensitive to where the oil price is at. The bigger integrated guys are more likely to be able to pick up some of these assets during these times when they become distressed. With regards to the SMAs, Clint, did you want to touch on?
Yes, so within the SMAs, they use a global energy ETF. And again, when you look at the list of companies that make up that particular index, it's very much skewed towards the companies that you would know, the integrated oil and gas producers, the BP, Shell, Exxon, Chevron. In terms of individual holding, the other one that's probably of note for most portfolios is Woodside. So our largest oil and gas producer domestically is a key portfolio holding. That's something that we've been buying more of with the recent weakness.
Somebody's also asked, Clint, I might get you to keep going, about if you can just sort of re-highlight the exposures that we've been adding to the portfolios, at the SMA portfolios.
Yes, so again, roughly about 11% increase in growth assets across, it doesn't matter whether you're looking at the fund or the SMA, roughly 11% across the last 2 weeks or so. And to an extent, that's gone back into broad market equity markets, so both Australia and globally, particularly the US, but not just the US, others as well. But really, it's isolating those opportunities where we can see significant value, like the energy market.
Sorry, excuse me. There's a question here saying we express concern about the bond market and its function as a defensive tool in times like these. What would it take for that to change? It's mainly concern about it being a defensive tool is the question of, are you being rewarded for the level of risk that you're taking on? Now, with interest rates at all-time lows, as you remember, there's that inverse relationship between yield and price. So with yields significantly low, there's kind of only one way for them to go, which is up. And then as they go up, you get price falls, so you get capital losses. To get capital losses in your defensive asset is not necessarily ideal in any way, shape or form. We're also starting to see spreads blow out. So the amount that which a corporation can finance over and above the risk-free rate is blowing out considerably. So as that rises, so as those spreads blow out, again, you get that fall in price. So, we're anticipating issues here. And interestingly, I think I mentioned before that over-the-counter markets, in particular fixed income markets, we're starting to see liquidity issues. A manager in the market today announced that the sell spread on their fixed income capability, on their indexed one of their indexed fixed income capabilities was going to 1.79. So, there's certainly some issues in actually trying to sell those assets, which is the advantage of the way we invest, right? We by holding significant levels of cash going into this, we actually don't have to sell down these assets at silly prices or at huge expenses where you just get crushed on the price, because we can just deploy the cash effectively to get those positions that we're after.
And I should touch on cash, Jody, because we're talking obviously about the growth assets that we're investing in, and the obvious question is, well, how is that funded? It is funded predominantly from cash. So again, leading into this period of volatility, our cash levels for a growth portfolio were up around 23 or 24%. As you say, these assets start to come on sale. We've got the cash in our wallet. We're in a position to go and buy. At the moment, a cash rate for the growth managed accounts around about 13 or 14%. So we're still holding ample if we see further opportunity. If it helps in terms of an overall growth defensive split, the long-term asset allocation for that portfolio would be 70-30. So we're still not at that level yet. We still think the risk of loss in certain markets is still there. But it's us absolutely increasing our growth assets in a way that makes sense to do so, given the valuation opportunity that we can see.
Yeah. Okay, so there's a question, another similar question. There's a few questions. I might sort of collate some of them because they're similar themes around sort of debt and, understanding some of the issues in the bond market. So, for example, Qantas and laying people off and concerns about defaults in the bond market. How are we thinking about fixed income in a world where the risk-free asset class blows up? I would argue the risk-free asset class hasn't been functioning properly for a long time. The risk-free asset, of which all assets are priced off, is the US 10-year government treasury yield. That has been artificially rigged, can use that phrase, since the GFC. So basically you had the Fed going in and pumping bonds into the system to suppress yields. Now, if you think about an asset is only worth its cash flows that it can generate over time, and you discount those cash flows back, and you're discounting them back by the risk-free rate plus risk premium, if your risk-free rate is artificially low, then basically you're willing to overpay for any cash flow. And that's what happened. And that's why markets got so overvalued, which is why they were behaving irrationally, because they were willing to pay anything for yield, effectively, which is why we were predominantly out of those areas and out of those asset classes. If anything, the government are now central banks trying to actually get shape back into the yield curve. What we're seeing is repricing of risk. We're actually seeing 10-year yields are now, over the last couple of days, are starting to actually push back up, meaning that people now want compensation for the level of risk that they're actually taking on. So this could actually see the fixed income asset classes revert to more normal pricing. However, that will involve capital losses for people who are holding these assets. A view about dividends. I might let you have that, Clint, so I can then circle through some of these. So what is our view about dividends from the bank, given margin compression from lower lending rates? Did you want to tackle that one?
Yeah, I think, well, it's fair to say that the outlook for the Australian economy is probably pretty challenged. The trends were maybe declining even before the advent of coronavirus. So, it's hard to see where EPS growth is going to come from. Their dividends are, the payout is probably at the top end of the ratio that we would normally expect. That said, there's certainly some risks towards their dividends, but I don't know that we're expecting any material cut. If I could answer just generally a financials question, this more recent weakness has opened up opportunities in other parts of the financial sector. So again, we do hold small weightings to the banks, but more recent portfolio, and specifically that's CBA and Westpac only, not the ones that are more exposed to the SME, the business side. But more recent portfolio moves have actually been into some of the insurers, notably Insurance Australia Group and Medibank.
I'll just answer. We've got a couple more questions. We've got a few questions actually, but any questions that we don't get to, we will record them and we will provide answers to them. So I'm just sort of conscious of the time that we have left. One of the questions coming through is, what are the other global sectors that we're actually looking at? Energy, as we've already spoken about. A lot of the sectors we liked, we're actually just upsizing in. So we're talking about energy in Europe and US. We're talking about adding or having a look at US banks in particular have been really beaten up. And mainly because, again, when the yield curve was flat, it's difficult for banks to make money. So by the yield curve shifting, that should come down. And banks actually in general are starting to price at GFC levels. So the market is ignoring fundamentals. It's ignoring the fact that banks now have disinvested from all those businesses that caused them issues during the GFC, but also the level of capital that banks are required to hold is their stronger position than they were at the GFC. So does it make sense they're at GFC pricing? Probably not. So we're looking in those areas. We've added airlines. We see that as a bit of a call option. So the airlines, granted, will certainly have an impact from a revenue perspective during this period, but we still think there's a fair margin of safety there in some of these stocks. Not all of them, in some of them, particularly given that airlines usually are of national importance because they provide infrastructure that's really important, so they will get government support. But at the same time, a lot of people forget that a lot of airline businesses are more than airline businesses. Most of them are actually credit card companies, or frequent flyer companies. And in a lot of cases, they make more money from that part of their business than they actually do from passengers from A to B. So we've dipped our toe in the water there with regards to that. There's also a question around currency and why is the Aussie dollar taking a hit and what are we doing? Well, currency, what tends to happen in these times is the flight to safety and people start to repatriate money, etc. The yen always does well in these periods, so we have been taking some profits in the yen and converting it back to Aussie. And what typically happens is, perversely, even if the US is not necessarily fundamentally as strong, the US dollar does tend to strengthen as well, and that's what's happening at the moment. So the Australian dollar dipped to 57 cents overnight, which is quite low. We are looking to put currency hedges back in place at the moment in the portfolios. We have run out of time. I am conscious of the fact that the RBA has actually cut rates to 0.25. Haven't had time to actually digest what they've released with that, but we are happy to release a note with regards to that. And as I mentioned, these slides will be available. The recording will be available. Also, any questions that we haven't had a chance to get to, we will circle back on with regards to that. If you have any further questions you'd like us to answer, please reach out. We're more than happy to have a chat with you. Thank you for joining us.
Thanks, everyone.